Most people think defaulting on a student loan is just a financial inconvenience. It is not. It is one of the most damaging financial events that can happen to you, and the consequences are unlike almost any other type of debt. When you default on a credit card, the lender has limited options. When you default on a student loan, especially a federal one, the government has tools available to it that no private creditor does. And most borrowers have no idea what those tools are until they are already being used against them. This video is about what actually happens when you default. Not the sanitized version, but the full picture. Because understanding this is what makes people take the situation seriously before it reaches that point. Let us start with the timeline. On federal student loans, you are considered delinquent the day after you miss a payment. After 90 days of missed payments, your servicer reports the delinquency to the 3 major credit bureaus. After 270 days, about 9 months of missed payments, you are officially in default. For private student loans, the timeline moves faster. Many private lenders consider a loan in default after just 90 to 120 days of missed payments, and the consequences start immediately. Here is what default triggers on a federal loan. First, the entire remaining balance of the loan, not just the missed payments, but the full principal and all accrued interest, becomes due immediately. This is called acceleration. You no longer have a monthly payment. You now owe everything at once. Second, you lose access to income-driven repayment plans. You lose deferment and forbearance eligibility. You lose the ability to get additional federal student aid if you wanted to go back to school. Everything is frozen until the default is resolved. But the most aggressive tools are what come next. The federal government can garnish your wages without going to court first. Private creditors cannot do this. They have to sue you, get a judgment, and then garnish. The federal government skips that step entirely. They can go directly to your employer and take up to 15% of your disposable income before you ever see your paycheck. There is no court date, no warning, just a notice to your employer. They can also seize your federal tax refund. If you are expecting a refund this year and your loan is in default, the Treasury Department can intercept it and apply it to your debt. This happens through a program called Treasury Offset. You file your taxes, you expect a refund, and instead you get a notice that it was taken. This applies to federal refunds, and in some states, state tax refunds can be intercepted as well. And it does not stop there. The federal government can also seize a portion of your Social Security benefits. This may sound extreme, but it is real. Retirees on fixed incomes have had their Social Security payments garnished because of decades-old student loan debt. There is no statute of limitations on federal student loan debt. The government can collect on it indefinitely for the rest of your life if necessary. Now let us talk about what default does to your credit score. A default is the most severe negative item that can appear on a credit report. It stays for 7 years from the date of first delinquency. During that time, you will find it extremely difficult to get approved for a mortgage, a car loan, a credit card with a reasonable rate, or in some cases, even an apartment. Some employers check credit reports as part of background screening, particularly for financial roles. So a default can cost you job opportunities as well. The credit damage compounds quickly because there is not just one negative mark. There are months of late payment entries leading up to the default, then the default itself, and then potentially collection entries on top of that if the loan is sold to a collection agency. For private student loans, the process is different but still severe. Private lenders cannot use Treasury offset or wage garnishment without a court order, but they can and will sue you. Once they get a judgment, they can garnish wages, freeze bank accounts, and place liens on property. The statute of limitations on private student loans varies by state, typically 3 to 6 years. But the credit damage still lasts 7 years. Here is what most people do not know. There are ways out of federal default, and they are specific programs designed exactly for this situation. The first is loan rehabilitation. You contact your loan servicer and agree to make 9 reasonable and affordable payments over a 10-month period. Those payments are based on your income and can be as low as $5 per month in some cases. After you complete all 9 payments, the default is removed from your loan record. The late payments still show on your credit report, but the default notation itself is removed, which is a meaningful distinction. Rehabilitation can only be done once per loan. The second option is loan consolidation. You consolidate the defaulted loan into a new direct consolidation loan, which immediately removes it from default status. To do this, you have to either agree to repay under an income-driven plan or make 3 consecutive full payments on the defaulted loan first. Consolidation does not remove the default from your credit report. The old loan still shows as defaulted, but it gets you out of default quickly and restores access to repayment options, deferment, and federal aid. The third option for some borrowers is full repayment. If you can pay the full balance, which is rare, the default is resolved immediately. There is also a Fresh Start program that was extended in recent years as a temporary measure, which allowed defaulted borrowers to re-enter repayment without the full rehabilitation process. Whether this is still available when you watch this depends on the current policy environment, but it is worth checking directly with your servicer. What you should not do if you are in or approaching default is ignore it. The natural human response to financial shame is avoidance. You stop opening the mail, you stop answering calls. You tell yourself you will deal with it later. This is exactly the behavior that leads to wage garnishment and tax refund seizure, because the collections process runs on autopilot. Your silence does not pause it, it accelerates it. The calls you are dreading are actually the calls that can stop the worst outcomes. A servicer who knows you are struggling has options to offer. A servicer who has been ghosted for 9 months has no choice but to move to collections. If you are currently delinquent, behind on payments, but not yet in default, you have the most options. An income-driven repayment plan can bring your monthly payment down to as low as $0 if your income is low enough. Deferment or forbearance can pause payments temporarily. These are legitimate tools that exist precisely for moments of financial hardship. Using them is not failure. Using them is the smart move that prevents default. If you are already in default, the path back is real and it is accessible. Rehabilitation is the better long-term option because it removes the default notation from your credit. Consolidation is faster but leaves the record. Either way, re-entering the system is almost always better than staying outside it. The bottom line is this: federal student loan default is not like other kinds of debt. The government has collection powers that bypass the courts, reach into your paycheck, intercept your tax refund, and follow you into retirement. The credit damage is severe and long-lasting, but the exit paths exist, and you can use them. The worst thing about student loan default is not how bad it gets. It is how quietly it gets that bad while you are looking away. Do not look away. If this was useful, subscribe and share it with someone who needs to hear it. Drop a comment below and tell me where you are in the process. I read everyone.